Investing can feel overwhelming. Stocks, ETFs, index funds, fees, market crashes. It's enough to make anyone freeze. But what if I told you that mastering just 7 golden rules could put you on the path to long-term wealth, without the confusion, FOMO, or endless trial and error? In the next few minutes, I'm breaking down the 7 core investing rules every beginner must know, with practical examples you can actually use. Let's make investing simple, actionable, and stress-free. First up, diversification is the cornerstone of smart investing. You've heard the saying, don't put all your eggs in one basket, and in the world of finance, this is non-negotiable wisdom. Spreading your money across multiple asset classes, like stocks, exchange-traded funds, ETFs, index funds, and even a bit of bonds, acts as a powerful safety net for your growing wealth. The core principle is simple but profound. When one part of your portfolio is performing poorly, other parts can help balance out those losses, creating a much smoother and more predictable journey. Many beginners make the common mistake of chasing hot stocks they see hyped on social media or in the news. They might invest their entire savings into a single tech company or a trendy startup, hoping for a massive payout. This is a high-risk gamble. If that one company fails or its industry faces a sudden downturn, their entire investment could be wiped out. A diversified portfolio, on the other hand, is built to withstand such shocks. By holding a mix of US and international stocks, large and small companies, and different sectors like technology, healthcare, and consumer goods, you ensure that the failure of any single investment doesn't derail your entire financial future. Diversification keeps your portfolio safe, resilient, and positioned for steady, long-term growth. Next, you must learn to think long-term. Investing is fundamentally different from trading or gambling. It isn't a get-rich-quick game designed to deliver instant profits. True, successful investors operate on a timeline of years and decades, not days or months. They understand that the stock market experiences daily fluctuations. It goes up, it goes down. But the historical data is clear. Over the long term, the market has consistently trended upward. This upward trajectory is fueled by economic growth, innovation, and corporate earnings over time. This long-term perspective is your most powerful tool against market volatility. When the market inevitably dips or enters a correction, inexperienced investors often panic. They see their portfolio value drop and rush to sell their holdings, fearing further losses. In doing so, they make a critical error. They lock in their losses, turning a temporary paper decline into a permanent financial setback. A seasoned investor, however, views these downturns as temporary noise. They remain patient, stay invested, and trust in the market's long-term growth potential. This patience allows them to ride out the volatility and benefit from the eventual recovery, letting the magic of compound growth work for them over many years. Our third rule is to avoid FOMO, or the fear of missing out. This powerful psychological trigger is responsible for countless poor investment decisions. FOMO happens when you see everyone around you seemingly making a fortune from a hyped-up stock, a new cryptocurrency, or some other speculative asset. The intense pressure to join in before you miss the boat can be overwhelming, causing you to abandon your well-thought-out strategy and chase quick gains. However, investments driven by hype rather than solid research are incredibly risky. Just because an asset is trending on social media or being pushed by influencers doesn't mean it's a sound investment or that it aligns with your personal financial goals. These hot assets often experience extreme volatility and can crash just as quickly as they rose, leaving latecomers with significant losses. The smart move is to stick to your plan. Base your investment decisions on diligent research, your individual risk tolerance, and your long-term objectives. A disciplined approach will always outperform impulsive, FOMO-driven choices in the long run. Now let's talk about something that can silently sabotage your wealth: fees. Investment fees might seem small on the surface, often just a small percentage, but they can significantly eat away at your returns over time. The destructive power of high fees is amplified by the same compounding effect that helps your money grow. A seemingly minor 1% difference in annual fees can compound into tens or even hundreds of thousands of dollars lost over the course of an investment lifetime. For this reason, it's crucial to minimize fees wherever you can. Actively managed mutual funds, for instance, often come with higher expense ratios because you're paying a fund manager to pick stocks. In contrast, low-cost ETFs and index funds, which passively track a market index like the S&P 500, typically have much lower fees. By opting for these low-cost alternatives whenever possible, you ensure that more of your hard-earned money stays invested and working for you, maximizing your potential for long-term growth. Always check the expense ratio before investing in any fund. The fifth golden rule is to keep your emotions out of your investment decisions. The financial markets are often driven by two powerful emotions: fear and greed. During a bull market, when prices are soaring, greed can tempt you to take on excessive risk, hoping for even bigger returns. Conversely, during a bear market or a sudden crash, fear can cause you to panic and sell everything at the worst possible time. These emotional reactions are the enemy of consistent, rational investing. To combat this, you need a system. The best way to keep emotions in check is to create a clear, written investment plan before you start. This plan should outline your goals, your risk tolerance, and your strategy for buying and selling. Once your plan is in place, stick to it. Automating your investments through a brokerage can help by making contributions regular and unemotional. Furthermore, resist the urge to obsessively check your portfolio every day. Constant monitoring only amplifies emotional responses to normal market movements. A calm, disciplined, and systematic approach will always lead to better outcomes than one driven by fear and greed. Our sixth rule is a simple but powerful one: invest consistently. Many beginners fall into the trap of trying to time the market, that is, attempting to buy at the absolute bottom and sell at the absolute peak. The reality is that even seasoned professionals consistently fail at market timing. It's a fool's errand. A far more effective and less stressful strategy is to invest a fixed amount of money at regular intervals, regardless of what the market is doing. This practice is known as dollar-cost averaging, and it's your secret weapon for building wealth steadily. By investing consistently, for example, $200 every month, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your purchase price and reduces the risk of investing a large sum right before a market downturn. Even small, regular contributions add up significantly over the years, thanks to the power of compounding. Consistency is the key that turns small acorns of savings into a mighty oak of wealth. Finally, the seventh golden rule is to never stop educating yourself. In the world of investing, knowledge is your greatest asset. The financial landscape is constantly evolving, with new products, strategies, and economic trends emerging all the time. The more you learn, the more confident you will become in your decisions, and the less likely you will be to fall for scams or make classic rookie mistakes. Make a habit of continuous learning. Read foundational books on investing, such as Benjamin Graham's The Intelligent Investor or Morgan Housel's The Psychology of Money. Follow credible financial news sources, watch educational tutorials from trusted creators, and listen to podcasts that break down complex topics into understandable terms. Learning from the successes and failures of others can provide invaluable lessons. Your financial education is an ongoing journey, and the investment you make in your own knowledge will pay dividends for the rest of your life. Those are the 7 golden rules every beginner investor should follow. Diversify, think long-term, avoid FOMO, minimize fees, stay calm, invest consistently, and keep learning. Which rule resonates with you the most? Drop a comment below, and if you want more actionable investing tips every week, hit subscribe and turn on notifications. Let's make smart investing simple, together.